Hi traders and welcome back. Today I'm going to talk about trend following, which often said it's dead. Then some guy comes along and says it's not dead, it's still working. My conclusion is trend following in the classical way is not dead, and I'm going to show you why and what it's all about today. So first of all, let's define what I mean by trend following. And what this video is about really is classic trend following, like the turtle traders did in the 80s, like a lot of big hedge funds do it, CTAs do it. It's not about short-term breakout strategies or intraday trends, but really the classic approach where you try to get into a trend, try to capture a big move and then get out. Usually this is done by using price action, having a limited risk but open upside potential. This is really cut your losses short and let the profits run in action. I won't be able to go into a lot of details. I already decided to make it into two parts because otherwise it's probably going to be a bit too long. If you look at this example of a trade in US dollar, what you can see here is there's a new 30-day low, we go short and have then a trading stop on, and you can see the trading stop right here. In this case it just used a trading stop of 3 times the average true range based on the closing price. So we don't get out of the trade here, for example, when price goes above it intraday, but really on a close to close basis. So actually we would have gotten stopped out below here. That's a very simple thing to do. This can be taught in 5 minutes basically. But the problem is, using a trend following approach, you have to consider a lot more things which can become relatively complicated really quickly. And I won't be able to go into the details of all of these today, so I'm just going to give you an overview. So first of all, how does trend following work? The basic thesis here is that markets trend. They did 100 years ago, they did 200 years ago, they did 30 years ago, and they still do today. But the problem is that not every market is trending all of the time. Actually, it's quite the opposite. Most of the time, markets don't trend. This means if you use a trend following approach, you will lose money with most trades. So having a winning rate of about 30% is a very typical thing here. It's nothing uncommon. Still, most of the time there will be a couple of markets that trend very nicely. And that's where you're going to make all of the money. So if you look into last year, for example, we had the energies trending strongly, crude oil, natural gas, and so on. And also some of the interest rate markets, for example, the German Bund, trended strongly. So this would have been potential interesting markets. On the other hand, during the last year, the equity markets didn't trend, right? So there wasn't much to be made there. Same thing for the euro, didn't trend too much. So your job as a trend follower really is to capture these trends when they occur. You don't know when it's going to happen, but when it happens, you have to be there, you have to take the trade and stick to your rules. Missing a single trade in trend following can really make all the difference of a year's performance, for example. So you have to keep on doing your job whatever's going on, whether you're in a drawdown for a year already or you had just 20 losing trades in a row, doesn't matter. You have to keep on going, which is emotionally quite challenging, but that's the sort of like the price you pay being a trend follower. From that we can already conclude logically that, okay, we know not every market trends all the time, and most of the time they don't trend. So if we just trade one market or just one market segment, one sector, like for example, we only trade equity markets or we only trade US dollar currencies, that's not gonna work, because a lot of time these markets won't trend and other markets will trend, meaning you have to trade a lot of markets to make this work. And that's really the magic in trend following. It's gonna work if you trade a lot of markets all of the time. So from my research, what I found out that you should trade at least 20 to 30 markets, better even 50 or more. The more diversification you can get, the better here. So whenever you see someone talking about trend following, but then only looking at one market, just forget about it. Now the next question is, okay, if we want to trade 50 markets and we want nice diversification, how can we do it? And my conclusion is this is a futures trading game, period. You can't do it with ETFs because most of them are just equity ETFs, and the few commodity ETFs that are available, most of them have terrible liquidity and you pay a big spread. But even if you wouldn't have that, there still aren't enough ETFs to really diversify in the way you have to. It's also not gonna work with CFDs, which was sort of like what I was hoping for. And I looked around a lot of CFD brokers and checked out what kind of spreads have they, what kind of overnight rates do they have, what kind of swaps you have to pay, and so on. And my conclusion is it's not going to work in most markets. It's just going to be fine if you trade whatever, the euro for example. It's going to be fine if you trade crude oil with that approach. But most other markets like coffee or oats or lumber, you really get crazy spreads, meaning there's no way to overcome that. And I don't want to go into all the details here with CFDs right now. As I said, for a lot of markets that are traded a lot, popular markets, it's fine unless you're going into day trading. But the other markets, just forget about it, really. Next one, you can't do it with stocks because the correlations are simply too high. So you can trade Apple and IBM and Microsoft at the same time, but they are too much correlated, so you won't get the diversification you need. Also, equities usually are the worst performers regarding trend following. That's a market where counter trend approaches do a lot better. You can do it in Forex to some extent if you're careful. You have to consider the swaps and so on. If you just trade Forex, then if these markets don't trend, you'll be in trouble. Maybe it's possible also with options. I didn't look into it enough. Would be a lot of work to backtest. To be honest, I wouldn't even know where to get the correct data right now for all the options contracts. Now the problem with futures is, and that's why I looked at the other options, you're gonna need at least $1 million to start trading with some diversification if you want to follow classical trend following approach. For this reason, I think trend following the traditional way is not going to work for most traders. So unfortunately, that's my conclusion. I was hoping to find something there that's really tradable and usable, but so far I couldn't. Still, it's a very interesting approach, and it was really good to look into it because you could learn quite a lot about how such an approach really works. You get an idea how all the CTAs are functioning, who are following that approach. If you're still interested in this, even though you say, okay, it's probably not for me because I don't have $1 million to trade, come back for the next video next week. Till then, have a good time and thanks for watching.